Ladies and gentlemen, good day and welcome to the Q4 FY22 and FY22 conference call of JK Lakshmi Cement Limited, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaibhav Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Inba. On behalf of PhillipCapital India Private Limited, we welcome you to the Q4 FY22 and FY22 call of JK Lakshmi Cement. I need to highlight that JK Lakshmi Cement is also the holding company of Udaipur Cement Works Limited, and therefore the call is also open for discussion about the performance of Udaipur Cement Works. On the call, we have with us Mr. Sudhir Bidkar, CFO of JK Lakshmi Cement, and Dr. Shailendra Choksi, full-time director. He is expected to join the call very shortly. I would like to mention on behalf of JK Lakshmi Cement and its management that certain statements that may be made or discussed on the conference call may be forward-looking statements related to future developments and current performance. These statements are subject to a number of risks, uncertainties, and other important factors which may cause the actual developments and results to differ materially from the statements made. JK Lakshmi Cement Limited and the management of the company assumes no obligation to update or alter these forward-looking statements, whether as a result of new information or future events or otherwise. I will now hand over the floor to management of JK Lakshmi Cement for the opening remarks, which will follow by interactive Q&A. Thank you, and over to you, sir.
Thank you, Mr. Vaibhav, and good afternoon, ladies and gentlemen, for this Q4 Concall of JK Lakshmi. Results you would have all seen, so without any waste of time, I'm leaving the floor open for question answers.
I think so, Mr. Can you just try correcting Mr. Choksi once before we start the Q&A? He's trying to give the call.
Yes, sir. Dr. Choksi is now connected to the call.
Okay, thank you.
Ladies and gentlemen, we'll now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. We'll take the first question from the line of Shravan Shah from Dolat Capital Markets. Please go ahead.
Thank you. First of all, congratulations on robust performance on QOQ level. Sir, first question, obviously the normal question is on the costing front. So we have seen improvement on the power and fuel costs and other expenses. So if you can help me, because last time when we had a call, we said that in terms of the power and fuel cost for us for Q3 was 9,500 per ton, and we were expecting 10,000 for this quarter and 80-85 rupees kind of an increase. But actually it has declined on QOQ front. So if you can help us, what was the cause and why it has declined, and how do you see the second quarter in terms of the power and fuel cost?
Yeah, thank you, Shravan. This, as far as the power and fuel cost is concerned, the first thing is that the full benefit of the waste heat recovery project of 10 megawatt, which was set up and installed in Siroi, that has come in. That is number one. So that has helped us to reduce the cost as far as power and fuel is concerned. Other than that, obviously the change in the mix has more benefited us basically, and we have started using more of the alternate fuel. Basically, it's about 14% now we have been able to use as against 10%. Other than that, the full impact of the increased inventory cost will come in the coming quarter, obviously.
So for in terms of the cost level, so for this quarter, per ton power and fuel consumption cost was how much, and what is now, and how much increase we are expecting now in this quarter at least?
It will be basically because of the higher cost inventory, which will now get utilized in the current quarter. And the full benefit of the waste heat recovery was already there. Some efficiency improvement in that will also help us to offset that but still there will be, we expect that to be there.
But any number in terms of how much increase we can expect in the first quarter?
Would be anywhere now. That last time we were able to clock it at around 9,000. That was the average cost of the fuel which was debited that time. It will be at least 7-8% higher than that.
Okay. And in terms of the other expenses, sir, is there any one-off or anything that you want to highlight, or this run rate, because all other PP bags and all the costs should be higher on QOQ, but our cost as other expenses has declined sizably. So if you want to highlight anything.
That is, you are talking of the decrease in cost on QOQ basis or what?
QOQ, sir. So from 168 crore, 149 crore other expenses.
Yeah.
On consolidated basis, sir, I'm talking.
Huh?
On consolidated basis, I'm talking from 168 crore to 149 crore.
We should discuss on it separately for each company rather than on a consolidated basis. Your other expenses, they have basically come down on account of the lower fixed costs and lower advertisement costs.
Okay. Sir, now a couple of data points, sir, in terms of the trade mix, trade non-trade, lead distance, road rail mix, and the fuel mix for this quarter.
Fuel mix, we had done, as I mentioned, we have done about in this quarter about 30% of coal, 56 pet coke, and others biomass, etc. about 8%. As far as the trade is concerned, we have done 55% in this 56 in this quarter over for 55%, and 8% is 55, and lead distance 395.
395. And railroad mix?
We don't have any this thing railway facility in East as of now. So basically we are doing.
And for North?
North, Rajesh, will come back on exact.
Okay. And in terms of, sir, have we finalized in terms of the right issue for funding the expansion? So I heard Choksi's interview on the channel. So I hope nothing changes in terms of the costing front, whatever we mentioned last time, 1650 crore. So just wanted because last time we talked about that we will discuss the right issue.
Yes. Right issue has been WL and their board meeting held on 17th, and the project was 16.
Okay. All the best and thank you.
Thank you.
Thank you. We'll take a next question from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Thank you very much, sir. So my first question relates to realizations and prices. Now, there has been a lot of talk about price increases. So can you give a sense of what is the price today versus the March quarter average in your key markets?
We have seen some increase in the month of April by about 25 to 30 rupees a bag. That varies from market to market. But on the average, you can say about 25 to 30 is there in our market in the north. As far as the east is concerned, we have seen an increase of about 15 to 20 rupees a bag.
And sir, this 25 to 30 in the north taken in the month of April, has it been fully absorbed into May? What is the sense of demand? Because year-on-year demand comparisons may not be valid because of last year's Delta wave. But how is demand trending at this point of time, especially government projects because they work on a fixed price basis?
Normally, April gets slightly reduced demand. I'm answering your second question first. In April, the demand goes down because of the harvesting. This year, the impact continued till almost first week of May. because the delayed return of the labor from their native places, and that has impacted the demand to an extent. The demand was also impacted in one of our major markets because of the aggregate supplier strike, which now has been called off. So I am expecting now the demand to pick up, which was delayed by about 15 days in the month of May. Now that should pick up when the aggregate supplies have been resumed. And also the high temperature this year relative to the earlier summer, that also affected some of the markets in Haryana and UP. But gradually we are hoping that this thing will subside and demand will pick up, because we still have 2.5 months to go before the monsoons start impacting the north.
Understood, sir. Understood.
Comparatively, the demand has been good in East, and it will continue to be so, I hope so, by till end of June, when the rains hit there slightly earlier. On about your first question on the pricing, the price increase did not materialize on 1st of April, but on varying days in different markets in the north. But one can say that from around 7th, 8th of April, we have been able to get that price increase, and they have sustained so far. Because obviously, everybody is under great compulsion to offset the increase in the cost of the inputs.
Understood. And sir, my last question essentially is that if you were to take today's coal prices, today's petcoke prices, basically the prevailing spot prices of various commodities, which given that we are in May will fully flow through in the September quarter in your P&L. Sir, how much percentage increase would the power and fuel cost on a per ton basis be versus what you reported in the March quarter?
There would be at least 25% increase will be there.
So around 250 rupees a ton.
Sorry?
Around 250 rupees a ton, sir?
It will, on a current pricing, because current prices are almost touching 400.
Yes, sir. Yes, sir. Which is why.
Yeah.
Understood.
There are not that much.
Okay. Thank you very much, sir.
Thank you. Our next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hi. Thank you for the opportunity. Sir, a few basic numbers about sales volume, standalone, console, and clinker.
Sales volume in this quarter were on a standalone basis 31.44 lakh tons of total, which includes 29.16 of cement and 2.28 of clinker. And on a consolidated basis, it is 30.80 cement, 2.11 clinker, and 32.91 cement total.
Okay. And sir, what about production?
Production what?
Production number of standalone and console and UCW.
Consolidated production is only summation only, because production doesn't get offset. So JK Lakshmi production in quarter was 26.19 cement, and UCWL production, just a second. UCWL production was 4.21.
What was the RMC revenue in this quarter and non-cement revenue? What is the non-cement revenue in this quarter? Out of that, how much is RMC?
Rajesh, बोलेंगे आप?
This quarter.
This quarter, the total non-cement revenues were 103 crores, out of which RMC was 48 crores.
And lastly, any change in timeline or something on UCW expansion front, or it remains as it is how it was in last call?
Yeah, we expect to get it commissioned by March of 24.
And what was the renewable power share in the total renewable power share for FY22 and this quarter?
So renewable power share is close to about 40% for us in this
Okay.
Right.
Okay. Thank you. That's it from my side.
Thank you. A reminder to our participants, if you wish to ask a question, you may press star and 1. Our next question is from the line of Sanjay Nandi from Ratnamali Investments. Please go ahead.
Good evening, sir. Thank you for the opportunity.
Good evening.
Yeah, sir, just correct me if I'm wrong. Like, we have already taken a price hike of 25 rupees per bag, which means like 500 rupees per ton increase has happened. So is it fine enough to offset the cost that has increased from March quarter?
No, not exactly. It may not be good enough. Because besides the fuel cost, there has also been an increase in the cost of the freight, which too has moved up by about 10%. So I think there is a need to compensate that as well. So, therefore, we are looking at further increases, but much will depend when the demand really steps in a meaningful manner. Then only an increase would be possible.
So, sir, what kind of incremental hike is we need to take to offset that rise in the freight cost?
A minimum of 15 rupee a bag would be necessary for compensating to some extent.
50 rupees a bag, 50, right?
No, 15.
1 by 15. Hello. Hello.
Hello.
Hello.
Yeah, we can hear you. Hello.
Okay, yeah. So you mean to say like 40 rupees a bag will be like fine enough to cover all the costs, both the power and fuel and as well as the freight cost, right?
One also has to see whether, besides my need, the market's ability to digest the increase, because there has been all-round increase in the cost of construction, and the increases beyond a point will affect the demand itself. There's a very fine calibration between the maintaining the demand and as well as getting the minimum remunerative price.
So, sir, what kind of EBITDA per ton can we expect for the full year of FY23, sir? Considering the situation, the price will not get absorbed in a full extent or something like that?
I think it will be rather premature to, do a guesswork at this point of time when there are so many of uncertainties. But one would obviously try and look for bettering your previous year.
Got it, sir. Sir, what is the debt figure as on the book, sir, as on this quarter, both for the standalone and the Concall basis?
Baggaji, would you like to?
Standalone, we have 960 crores of debt. On a consolidated basis, about 1850. Because they have raised, UCWL has started raising money for the expansion project. So in the March quarter, they raised about 50 crores of NCD. So that's the reason as to why their debt has gone up. So it is total.
1850, right? On a Concall basis.
Yeah.
Got it, sir. Sir, that's it from my side. Thank you so much, sir. I'll be back in the queue, sir.
Thank you. We'll take a next question from the line of Naveen Sahadev from Edelweiss. Please go ahead.
Hello.
Yeah.
Good evening, sir.
Good evening.
And once again, congratulations on great set of numbers. My question was more on the valuation front. So of course, performance is great. In general, the balance sheet has seen material improvement. Now there is growth visibility. The ROE numbers look fantastic. Wanted to, and I'm sure investors would also be eager to hear this, that in your assessment, what is the reason for JK Lakshmi trading so cheap, materially cheap, if I may say, versus other stocks, especially north-based or east also for that matter, where there is enough growth?
Basically, we don't see any reason. We, as management, we perceive we are undervalued. It is for the investors like you to analyze and let the market know that this is an undervalued stock and has a potential for a huge upturn. I don't see any reason why it should be valued at such a low rate, because it has huge potential. Only thing, it's a question of people keep asking about the question of 1,000 rupees a better per ton. That eventually will come. We have done all the things right. Whatever efficiency improvements were required to be done, we are already working on that. Other improvement will come in due course and will graduate to that level. I hope that once we do that, that re-rating will happen.
Appreciate. So can you, for the sake of repetition, can you please mention what are the immediate efficiency enhancement measures? Like you recently did waste heat recovery of 10 megawatt. So is there more such efficiency measures which you would like to highlight at this point in time?
Other than the waste heat recovery, we are also using some solar capacity at various plants, and we have adequate land on that. Secondly, a continuous effort to reduce the logistic costs, improve the trade, do more of direct dispatches, increase blending levels. All this will help us further improve these logistic costs and thereby reducing our freight and other logistic costs. That will further help us to improve, because efficiency-wise, in terms of cost of production, we are already one of the least cost producer. So we been last 2 years we've been working closely on improving our logistic costs, and so those things will start bearing full benefits. We'll start getting full benefits of those efforts which we have started pursuing over the last couple of years, and that should help us to graduate to this. This year we would have graduated to obviously 1,000 rupees, but for this fuel cost increase. But going forward, we definitely hope to do so.
We also believe that there has been some concern on the the working at East at Chhattisgarh unit, but I think that too has improved now this year considerably. The price regime at Chhattisgarh has been quite low, and that possibly could have been a reason. But I think that correction has taken place, and that should also help. But I think more than that, we would be keen to hear from investors like you. What, in your opinion, needs to be done for correcting the rating?
Appreciate your response. Just one question, if I may. The expansion that we are currently working on is at UCWL. Is there a possibility or rather a feasibility from a limestone availability perspective that we can have these expansions also at the standalone entity level going forward, or there will be a challenge to that?
We have capabilities and the limestone availability at both Sirui as well as Durg to go for expansion. So
if need be, we can go for another line, another clinker line there.
Yeah. Either at Durg or at Sirui, the capabilities are there, or also the resources are there.
Appreciate. Thank you. Thank you so much, sir.
Right.
Thank you. Our next question is from the line of Sandeep Bansal from ASK Investment Managers. Please go ahead.
Yeah. Hello, sir, and thanks for the opportunity.
Sorry, Mr. Bansal, could you switch to a handset mode? We can't hear you clearly.
Is this better now?
A management team, can you hear Mr. Bansal?
Yeah, we can.
Yeah. Thank you, sir. Firstly, I wanted to understand on the cost side, there has been a reduction in employee costs also. So is this purely because of volume, or there is some other element to it as well?
Sorry, come again. Can you repeat your question?
Sir, the per ton employee cost has also gone down. So is this only because of higher volumes, or there is some other element as well?
It's because of the higher volumes.
That is the only thing. There is nothing
Yeah.
else.
Yeah, nothing else.
And sir, on the other expenses, you said that there were lower advertisement costs and efficiencies in fixed costs. Sir, what was the nature of such efficiencies, if you can spell out?
So it was lower fixed cost was basically, as I mentioned, for two reasons. One was the lower advertisement cost, and other fixed cost being the other expenses. Primarily, last year we had done this IPL. This year we did not do IPL. So that is one cost which has come down. But overall advertisement cost and other cost has come down. Overhead cost.
Sir, these changes in overhead costs, are they sustainable in nature? So, or was it more like one time?
We believe that those are sustainable.
Sure, sure. And so just the last question on power and fuel costs. Sorry, I got confused. To one answer, you said that the power and fuel cost could increase by 7 to 8% this quarter. And on another question, you said that it could increase by 25%. So 25% was more factoring in the current coal cost, is it?
Yeah, current coal. That question was in response to if entire P&L was to be charged with current cost of procurement of coal, and the 7-8% was on a sequential basis based on what is likely to be there in the first quarter.
Sure. So in the last quarter, we would have actually benefited from lower cost coal inventory, right?
Right.
Okay. Sir, if you can also maybe just restate the fuel mix for the last quarter.
That was about 30% was coal, 56 was pet coke, and 14 was other alternative biomass.
And so last quarter, this pet coke mix would have been far lower.
Pet coke was 60, biomass was lower. In fact, that's the reason. 10%. It was against 14% this quarter.
Okay, so we would have benefited also because of that.
Yeah, you're right.
Sure. Okay, thank you so much, sir, and all the best.
Yeah, thank you.
Thank you. Our next question is from the line of Uttam Srimal from Axis Securities. Please go ahead.
Thank you, sir, for giving the opportunity, and congratulations on a good set of numbers. Sir, my question pertains to our capacity utilization. Since on a standalone basis, we are already at 90% capacity utilization. So how do you want to grow the volume? So any volume guidance for FY23, sir?
We can further increase the capacity utilization and improve the blending. That can always go up, you see. So that will help us improve the volume.
Okay, sir. Sir, what has been the blending ratio this quarter?
Sorry?
Blending ratio?
Blending, we did about 55% blending.
55%. Okay. And sir, with regard to value-added products, so what kind of traction you are seeing in value-added products, and what could be your guidance for this year?
As far as value-added products are concerned, and this full year we did about total value of about 373 crores. So we would see some improvement therein, maybe 8 to 10% value growth.
Okay. And now last question, sir, one on premium cement. So how has been the sale of premium cement out of trade mix?
We are doing over 25% of our trade sales in the premium segment.
Okay. So it has increased from last quarter, or it has remained the same?
So that always keeps improving on it.
Okay, sir. Thank you, sir. That's all from my
Thank you. Our next question is from the line of Kamlesh Bagmar from Prabhudas Lilladher. Please go ahead.
Yeah, hi, sir. So one question on the part of MAT credit. So how much is the balance left as on FY21 and FY22?
FY22, we have a balance of about 260 crores left.
Okay. And how much we have consumed in this year, sir?
We would have consumed about 44 crores.
And sir, on the part of this expansion project, sir, so
Yeah.
like, is it 1550 or 1650? What is the capex cost?
1650, 1650. 1650, it is being funded through a debt equity of 2:1. 1100 crores is the loan and 550 is the promoter's contribution, out of which they have announced the rights issue, which may be up to 450 crores.
Okay. Okay. And sir, like, given the cash flows which we are generating, like say operating cash flows, we will be having around 800 odd crore, and this capex will be spent over 2.5 years. So, like say our net debt has peaked out in this year, or it would go further from the current level. I believe we have a net debt of roughly around 650 crore, which is down 20 odd % year over year.
Net debt position basically will depend on how much we are borrowing going forward for this expansion and when we are doing that borrowing. So we expect the net debt, which is presently on a standalone basis about just a second, is about almost negligible is there, net debt. On a consolidated basis, it will increase obviously because of this borrowing which we do for the expansion. Maybe maximum about 100 odd crores, 100 to 150 crores it will increase.
Okay. And sir, on the one question regarding this margins, like say this quarter we have done margins upwards of 870 rupees, and we have took a price increase of at least like say 250 rupees on net basis. And even if I take 10% quarter-over-quarter increase, even in fuel and the freight, we would be easily able to maintain the margin quarter-over-quarter. No doubt there would be lower volumes quarter-over-quarter, but given the numbers we have suggested in the power and fuel cost, we are saying hardly 7 to 8% increase would be there in power and fuel cost quarter-over-quarter. So why we are not seeing the margins getting improved or even getting maintained at these levels?
We don't see any reason why it should not be maintained. We will endeavor to maintain it. There is no reason why it should not be. But it depends on how much the price increase which you have taken sustains through the quarter.
And the volume that one is able to get, because as I was mentioning earlier, the demand was impacted in April and May also, partly because of that aggregate strike in Gujarat. And Gujarat is a big market for us. Of course, it has now since resumed, but the volumes would probably be impacted for the quarter as a whole.
Okay. And because lastly, like, can we provide the figures on kilocal basis, like say this quarter and last quarter, Q3 and Q4, how much was the power and fuel cost per kilocal or 1,000 kilocalories?
That I don't have figures right now. We can separately provide offline.
Great, sir. Thanks a lot.
Thank you. The next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
My question pertains to first, again on the margins. We see this sharp fall sequentially in the absolute employee cost and other expenses. One explanation for other expenses you mentioned is reduction in advertisement cost, but the amount seems to be significantly lower. So, were there some big provisions which had been reversed in this quarter? Also, if you look the other expenses as percentage, historically last 7-8 quarters have ranged between 12 to 13%, whereby this quarter it has come down to almost 9% odd on a console basis. So how do you read into these numbers?
Actually, what happens when we do the quarterly accounting, and at the start of the year we make a budget of various expenses, and all the expenses not get booked on a quarterly basis. So at times they make a provision in the respective quarters. Otherwise, if all expenses were to be booked in the fourth quarter, then obviously then those loading will come in the fourth quarter.
Yes.
At times it so happens that when we do a pro rata provisioning quarter-wise, in the year we find that actual expenses may in some cases be lower than the provision which we have made through the year. So that's the reason obviously the total cannot exceed whatever we have actually incurred in the fourth quarter and for the year as a whole. So obviously that adjustment gets done in the fourth quarter. Otherwise there is no reason as to why there should be some aberration. But we are working very hard on that, reducing our overhead costs, reducing our other costs, be it advertisement or other costs. So that we are working very hard on that. So that is the reason at the time.
Okay. And secondly, in terms of the fuel cost in Q4 sequentially, what was the impact versus Q3?
Sorry, Q3?
Q3 versus Q4, how did your fuel cost, which is 9,000 rupees per ton in Q4, how did that number move between Q3 and Q4?
Q4 it was 9,400. So because of this increase in the our waste heat recovery capacity generation and also increase in the other biomass consumption from 10% to 14%, that has helped us to reduce the overall cost.
No, this 9,400 was how much in Q3, sir?
9,400 it was for Q3, 9,000 in Q4.
Okay, from 9,400 it came down to 9,000. If I'm not confused, is that right?
Right.
Okay, and sir, a few more questions in terms of the electricity and green fuel. Green fuel, this biomass, it has increased from 10% to 14%. Is that understanding right? And is that a sustainable number for you, or it can go further from here on?
It should be sustainable, but at times in monsoon there may be some issues. Second quarter blips may be there, but otherwise it should be sustainable.
And so the per kilocal costing would be much cheaper compared to your normal fuel mix?
Yeah, you're right.
Less than 1 rupee, is that a fair understanding?
That I don't have, but I need to check it out and confirm.
Okay. And sir, this blended cement mix at 55%, any thought on increasing this to say 70% odd? And if so, by
it will happen in due course. It will happen. The question which was asked, if the capacity at clinker level is fully utilized, how we further increase the volume? So that will come through the improvement in blending only. So there is ample of scope for further without clinkerization increasing capacity. We can increase the volume, cement volumes. Ample of scope.
Okay, great. And two last questions: clinker production at both the units, Udaipur and JK Lakshmi, and will the capex for the Udaipur will be spread equally between next 2 years?
Capex, as far as is concerned, you are right. Broadly, it should be around that level, and maybe 1650, maybe around 700 in the first year, 900 in the second year. That could be. And volume is 26 cement production is 26.19 for JK Lakshmi and 4.21 for UCW.
Clinker, sir?
Clinker is 17.35 for JK Lakshmi and 3.3 for UCW.
Okay. And if I can take one last question in terms of your net debt, which is around 650 crore currently on a consolidated basis.
Sorry, can you repeat your question?
Sir, consolidated net debt number, which is at 650 crore on a consolidated basis, given that you will be borrowing 1,100 crores, over next 2 years, what would be the net debt level that you are looking at, peak net debt, at the end of FY24 sort of number?
As out of this 650, out of this 1,100 crores, we have already done a borrowing of 350 crores in JK, in UCWL, right? So what is about the balance about 750 or so, right? And then in next 2 years, the repayment plus the generation should not see any major dramatic improvement in net debt on a console.
Okay. So you expect the net debt on a console basis to remain under 1,000 crore?
Yeah, for sure.
Okay. Great, sir. That's all from me. Thank you.
Thank you. Our next question is from the line of Rishabh Shah from Anubhuti Advisors. Please go ahead.
Thank you for the opportunity. First question, out of the total CapEx guidance of 1650 crores, what are we targeting for the current financial year?
About 700 crores.
That will be at the console level.
You are talking of 1650. That is an expansion project of UCWL.
UCWL, yes. And for standalone?
In response to that, I am saying that out of that, about 700 will get spent in the current financial year. In JK Lakshmi, we are not doing any major capex, so only normative capex of about 70-80 crores would be there.
Okay, so in all, it can be around 780 to 800 crores of number.
Yeah. So depending on the progress of the project, around 800 crores would be there.
Understood. And the second, with respect to our current cash and borrowing levels, so if I can combine the current investments and cash balance, that roughly comes up to 1200 crores, and versus that our debt levels are at roughly gross debt is at 1850 crores. So balance will be basically used for this whole capex purpose, no?
Sorry?
I just wanted to understand why was at so elevated levels in the books. Will this be completely used for the capex part?
Cash levels are at elevated level at the year end for two reasons. One, we raised an NCD of 350 crores on 16th of March, right? So 16th of March till 31st of March in UCWL, whatever could be utilization balance is appearing in their bank balance, almost 300 crores plus. Similarly, in JK Lakshmi, we raised an ECB of about 10 million in last week of March. So about that amount is about 75-80 crores was there in the cash and bank balance. But it will get utilized in the project for which the money has been raised. Other than that, the balance, cash balance is the normative cash balance which the company carries. And in the current year, in JK Lakshmi, we may use in the rights issue for subscribing our share in the rights issue of UCWL. So that will further get used apart from further addition into the yearly cash generations in JK Lakshmi.
Understood. That's all from my side. Thank you, sir.
Thank you.
Thank you. Our next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, thank you for the opportunity. I have two questions. First, after the 10 megawatt capacity expansion of WHRS that we have done, how much further scope we have to expand on WHRS, and what is the pipeline we have right now?
Frankly, we don't have much scope now on further addition in the waste heat capacity. We have reached the 33 megawatt waste heat recovery, which is 25 at the mother plant in Sirohi and about 8 in Durg. As of now, we don't see any further addition, but some technical improvement can always increase the capacity by 1 or 2 megawatt. There may not be any quantum increase out like we have done this time. So there may not be any opportunity there. Some technical innovation improvement can always help us to increase that 33 capacity to 35, 37 like that.
Yeah, but the new capacity expansion that we are doing, it will be
at Udaipur, obviously at Udaipur, obviously with the new capacity expansion, new clean will have a waste heat recovery of about 7-8 megawatt.
7-8. Okay, thank you.
So that is in Udaipur.
No, that is helpful. And initially, you talked about demand in April and May and how the material costs across, not just cement, other materials is impacting demand. So if you can give some more color on how April demand has been. I know YOY comparison may not be the best indicator, but say from 2-3 years back, say April 19, which would be more cleaner year, would we see a growth in April 22 over April 19 for the industry, and how do you see May panning out so far?
It has been more or less at the same level as April 19. And as I was telling you, that part of the region could be, east was better, definitely, better about 7-8% compared to April 19. But in north and west, it remained more or less at the same level. And Gujarat, it actually got impacted because of the strike. So again, it's a one-off reason. And one would expect that growth to now be visible in May and June.
Sure. Thank you. This is very helpful. That's all from my side.
Thank you. Our next question is from the line of Dharmesh Shah from MK Global. Please go ahead.
Thank you. Thanks for giving the opportunity. So just I have questions on the sales mix. Is it possible to provide the sales breakup between the north and east region?
We don't provide that, sorry.
Okay. And sorry to further get you on the cost side, but can we get a sense on the ad spend figure for the Q4 21 and Q4 22?
Sorry?
Can we get an idea on the how much will be the ad spend figure for the Q4 FY22 and last year figure?
Headwise expenses we don't share in the investors call, please. Sorry.
Sure, sir. And sir, is this the correct understanding that in the Q3, because of the strike, we have built up some inventory and that inventory has also benefited in this quarter?
Yeah, obviously that was there was a strike in the eastern side, no, Durg plant, where transport strike, which impacted. So that impact was the production was also cut down, no? And the strike was there. It's not only the dispatches. So some benefits were there. Some carry forward inventory was there, clinker stock. So that helped us in the last quarter. But
those levels can be sustained. If you are looking at question from the point of view whether this will be sustained or not, this can be sustained from our production level.
No, sir, I am just thinking because our Q3 EBITDA per ton has actually impacted more than the industry, and we have surpassed in the Q4. But when I normalize for the H2 numbers, then it's in the range of 750 rupees per ton. So I am just trying to get a sense that how much improvement we can see from the 750 rupees, or it will be broadly remain in this range.
There will certainly be an improvement over last year based on various efficiency drives which we have carried out, and full impact of which will come in the coming year. Barring these uncertainties regarding the coal pricing, petcoke pricing, and our ability to pass on the cost increase. But otherwise, other things remaining the same, it should improve.
Sure, sir. Sure. Thank you. Thanks.
Thank you. Ladies and gentlemen, you may enter star and 1 to ask a question. Please note that this is a final reminder for questions, and no further reminder will be placed after this. We'll take our next question from the line of Ronald Sioni from Sharekhan. Please go ahead.
Yeah, good afternoon, sir. I had one question regarding 1650 crore expansion. Like as you said, 350 crore was borrowing done by UCWL. So how much debt we are going to borrow with respect to this expansion? And apart from, say, right issue subscription, what would be, advances or funding requirement to be given to UCWL from standalone books?
As far as UCWL is concerned, this total expansion of 1650 is being funded through a debt of 1100 crores, out of which 350 was borrowed in March. Balance will come in the current and next year. The balance 750. So that will be 350 plus 750 will make it 1100 crores. As regards the promoters' contribution of 550 crores, about 100 to 150 will come from their internal accruals, and balance 400 to 450 would be the rights issue. And our subscription will be pro rata in the rights issue, depending on what who we hope that public will subscribe fully to their share of 25%. So balance will 75% will come from the parent company JK Lakshmi. So that will complete the entire funding of UCWL expansion.
Okay, great. So additional that 750 crore will be raised at UCW level only.
Yeah, naturally. Because the expansion is at there. So obviously there is no reason why it should be raised in JK Lakshmi. There will not be any additional fundraising for this expansion in JK Lakshmi. Not even a penny.
Yeah. Thank you very much. Thanks.
Okay. Thank you.
Thank you. Our next question is from the line of Naveen Sahadev from Edelweiss. Please go ahead.
Yeah, thank you for the follow-up. And just one more question. Sir, recently, as in the same board meeting, Arun Shukla ji has been elevated as a director to the company. So just wanted to understand, does it change any role for him? Does he get more responsibilities in the active day-to-day management? I believe he was looking at sales and marketing. So if you can just throw some light for his role in the day-to-day management.
He was not only looking after sales and marketing, he was looking after the entire operation as president of the company. So right from the day he joined, we have been talking that in the Concall earlier also, that he is basically the president of the company, looking after both the operations as well as the marketing side. So that is number one. And yes, you are right. In the recent meeting, he has been elevated to the level of the president and director. So obviously, his role will be wider as the president as well as the director of the company.
Thank you. Thank you so much, and all the very best, sir.
Thank you.
Thank you.
Thank you. Our next question is from the line of Shravan Shah from Dolat Capital Markets. Please go ahead.
Thank you for the follow-up. Sir, just two questions. First is the UCWL 1.5 MTPA, which is the next grinding unit. So currently by October we will be having a 1 MTPA grinding at Udaipur and 1.5 where it will come in Rajasthan.
Yes, good question. This we should have talked earlier also. Now, finally, after a lot of consideration, deliberation, and due diligence of various places, finally UCWL has decided to do the entire grinding capacity of 2.5 million at the mother plant itself. So there will not be any split location grinding unit for UCWL. The entire clinkerization of 1.5 million clinker and 2.5 million cement capacity will come. So while there would be some saving in the project cost on emanating from the shifting of the grinding unit from a split location to the mother plant, but that based on the recent increase in the commodity prices, we believe that we'll be able to curtail overall project cost within the earlier announced 1650. So while there will be some saving on account of the shifting of this, as I mentioned, split location to the mother plant, but then that will be more than offset by the increase in the prices like steel, aluminum, copper, cement, all that. So we, in spite of this commodity price increase, will not see any cost escalation in the project cost, which would remain at 1650.
Okay, so out of this 2.5 MTPA grinding, 1 MTPA will start by we are targeting to start by October 23 and the remaining 1.5 by March 24.
No, we are targeting the entire 2.5. A single grinding unit will come up in March 24 itself. Both clinkerization may take about 3 months earlier, can happen, but March 24 the entire 2.5 million grinding will come up.
Okay, because previously we were thinking to start by October. So now maybe the clinker will come by December and the entire grinding by March 24.
Yeah. As of now, that is what we do.
And there's a last question in terms of the trade mix. So I understand we want to increase the blending ratio and increase the trade share. But if I look at the last so many quarters, it is in the same range of 53, 55, so this quarter 56. So anything specific and then where we can increase and let's say any rough idea in terms of let's say from 56 to 600 on a yearly basis, is it possible by FY23? Particularly, is it in the north only or it can happen in east?
East we are already at standing level, but overall it will increase by about at least 4-5% every year. That is our target.
Okay. Thank you.
Of trade as well as blending.
Okay. Thank you, sir. Thank you.
Thank you.
Thank you, ladies and gentlemen. Due to time constraint, we'll be taking our last two questions. We'll take the next question from the line of Kamlesh Bagmar from Prabhudas Lilladher. Please go ahead.
Sir, would you please be able to quantify
how much was the IPL and that particular expense in the base quarter, and were there BCG consultancy charges in the base quarter?
There were some BCG consultancy, but headwise we don't provide. Sorry, these are there. How much is BCG? We don't share. Sorry.
But sir, on a steady run rate basis, how much could be the other expenses? Because if you see this year, on an average, it has been roughly around, last year, it was 500 rupees. Prior to that, it was around 370 rupees. And this quarter, it has been much, much lower as compared to what it used to be. And for the year as a whole, it has been roughly around 550 rupees per ton, but this quarter it was 400 only. So on a steady run rate basis,
550 will for the year is a right figure. Some escalation on account of the normative inflation will happen, but you can take 550 as a year and divide by 4 to assess the quarterly number, plus some inflationary factors.
And lastly, sir, on the power and fuel cost, no doubt, so the comparison is not feasible because on a per ton basis, because of the mix change, it won't be visible. But on a kilocalorie basis, going forward, 7 to 8% increase quarter on quarter.
I don't have the figure on kilocalorie basis right now. Separately.
But sir, 7 to 8% looks very small. Because so would we be seeing a larger impact in Q2, or how it would phase out? Because the way petcoke prices have gone up, and even if we see Q4 year over year, we are seeing hardly 40% increase year over year. So wanted some clarity on that part. Because waste heat recovery could have saved you hardly around 50 rupees, not more than that.
Waste heat recovery is that has helped us considerably apart from the improvement in the efficiency, but the full impact of the cost increase will, as I mentioned, will come in the coming quarters. Barring improvement in the further improvement, if any possible, through the biomass increases or the alternate fuel increases, which is now already at 14%. Our endeavor is to further increase, but let's see how much it will happen. That's the reason as to why it could be in the current quarter immediately 7-8% only. But if one were to see the full impact on the present procurement cost of the coal, it could be as high as about 200 rupees per ton plus.
Thank you. We'll take our next question from the line of Nishan Bagrecha from InCred Capital. Please go ahead.
Madam, I think I hope this is the last question.
Yes.
Because I have another meeting lined up.
This is the last question, sir. Mr. Bagrecha?
Hello. Quickly one question. So as you have shared the Q4 sales volume, so could you share the clinker production number or the sales volume for FY22 on a console and standalone basis? This is the only question I have.
Total sales volume were 105.77 lakh tons for JKLC, 96 lakhs cement and 9.78 clinker. And on console level, it is 112 lakh tons, 101 cement and 11 clinker.
Okay. Thank you, sir.
Thank you.
Thank you. I now hand the floor back to Mr. Vaibhav Agarwal for closing comments. Over to you, sir.
Yeah, thank you. So just one thing, because if you could also say the console volume for the full year adjusted for the intercompany adjustment, you can give that number, please.
Yeah, that is adjusted. Yeah, that full value 112 is adjusted for the inter-unit sale.
Okay. Thank you. Thank you. On behalf of Phillip Capital India Private Limited, we like to thank the manager JK Lakshmi Cement for the call, and many thanks for joining the call. Thank you, sir. Invite you now for the call. Thank you.
Thank you, Mr. Vaibhav. Thank you, everyone.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.